Welcome to the video on Forex pairs. My name is John Jagerson. This is brought to you by Alpari. And there are a couple of things that you need to understand about Forex pairs. And it is a little bit different than just about any other capital market. Number one, it's good to go over just a quick explanation of how a Forex pair actually works, and then what kind of Forex pairs are there. So why don't we take a look at an easy example. Probably the most popularly traded currency pair, and in fact we know this for sure, is the Euro USD. Now what that means is that it's essentially the exchange rate between the euro and the US dollar. In fact, if you're curious, about 27% of all Forex transactions, everything out there available, about 27% is in this particular exchange rate itself. If you add to that the yen, trades that involve the yen and the dollar and the pound and the dollar, you've got over half of all Forex transactions right there. So it's kind of interesting where the focus of most Forex traders is in a very small pool of currencies. Now the Euro USD, there are a couple of things that you need to understand about how a Forex pair works. The first currency here is called the base. The first one in the quoted pair is the base currency, and the second one is the quote. Now, in this case, what this really means is when you're looking at the exchange rate, which, for example, on the Euro USD, right now the exchange rate is at about 1.3011. And what that means is that currently it costs $1.30, well, and then even a little extra, so $1.3011 to buy 1 euro. So, and no matter what currency pair you're looking at, they all work like this. So this is one way to keep this straight. Now the second thing that you have to really understand is when you're buying or selling an exchange rate, you're essentially making an investment that one of these currencies is going to weaken or strengthen, as the case may be, versus the other one. So, which in this case, if we were to imagine that the Euro USD was going to go up, what we're really saying is that we think that the euro is going to gain in value versus the dollar. Because if this exchange rate increases, what that means is it's going to start costing more dollars per euro. So it will take more of a weaker asset to buy 1 euro. Now, the exchange rates go both ways, obviously. So if the exchange rate starts to fall, if this currency pair starts to fall, essentially what we're saying is that it's going to require fewer dollars to buy a euro. So the dollar is getting stronger compared to the euro. Here's a really easy way to shortcut this process, by the way. If you look at it like this, let's draw the Euro USD here, but let's put a line underneath it and a little fulcrum here in the middle. Now, whichever of these two currencies is heavier, is stronger, is going to tilt this particular seesaw. So, for example, if the euro is suddenly going to become much stronger and heavier, it's going to tilt the seesaw up, right? That's the same direction the trend will be going. Well, the same thing is true of the US dollar. If the US dollar is the one that's maybe not going to get stronger, but it's going to get weaker, then it's going to tilt the seesaw up as well, and that's the way the trend will go. The same thing is true in reverse. If the dollar were to get stronger versus the euro, it's going to push the seesaw down, and the trend will then start heading down. So it's a really easy way to look at a currency pair and its trend and to be able to determine, okay, right now the trend appears to be in favor of a stronger dollar or of a weaker dollar or of a stronger euro or a weaker euro. So it's easier for you to understand, well, what direction is based on which direction the trend is going, what's going on here fundamentally with this currency pair. Now we've talked about how a currency pair works, but like I mentioned before, there are different pairs that we pay attention to. Primarily there's two different classifications. So let's get to that next. Now I was just talking about two different kinds of currency pairs, and I also mentioned that there are a vast majority of investors are trading primarily 3 to 5 different currency pairs. But there is actually a lot of diversity out there, and most of it falls within a certain category. So there are, in the Forex, we look at the majors, and there's an easy way to remember what are the majors, and then we look at the crosses. And there's an easy way to remember those as well. So typically, the majors consist of the US dollar on one side of the transaction or the other. So this is, if a currency has the dollar in it, like the Euro USD, or the dollar CAD, or the dollar yen, or the pound dollar, whatever it is, it's one of the majors because it has the dollar involved. Most Forex transactions, being the vast majority of Forex transactions, have the dollar involved. The second most popular currency, period, to be on either side of these transactions is the euro. And once you've included those two, you have most transactions. Now, the crosses, however, are very important because they're a great way for you to diversify your investing, look for other opportunities, and as retail Forex traders, they're great opportunities. So a cross is something that doesn't have the dollar involved. There are very popular crosses. A lot of traders pay a lot of attention to the pound yen, or the euro franc. That's a very popular one. These are both crosses. No dollar involved here. You're trading, again, the value of the pound versus the value of the yen. The same way we would look at the euro dollar. And it works exactly the same way. Or the euro franc versus the euro versus the franc. So again, just like we were looking at in our example on the euro USD, works the same way. You just don't have the dollar involved. Now, a couple of characteristics you should be aware of. There are benefits with liquidity. So for example, there's more liquidity in the majors because they're more actively traded. And this translates into a couple of benefits. The first of which is, of course, it's really easy to get execution even during periods of extreme market activity. So it's relatively easier to get your transactions filled in pretty much every market conditions with the majors, and the spreads are typically tighter. Now the spreads are a little bit wider here on the crosses, so you'll see a lot of traders spending quite a bit of time looking for longer term trades in the crosses where those transaction costs of the spread are not as big of a deal. So no matter how narrow your spread gets, it's typically bigger here than it is over here, and it's a matter of just how actively traded are these particular pairs. Now, I always suggest, even with traders who are, and especially actually with traders who are new, to make sure that you're paper trading both the majors and the crosses. So don't just pick one currency and trade it to death. Diversify your experience so you start to get a feel for how these currencies relate to each other. The crosses are great for an educational tool to just start to understand, well, what kind of pressure is on the yen right now? Can I see that exhibited in some of the crosses? It helps to really connect the dots, if you will, between what's going on in the Forex market, what you're seeing in the news, and the price action itself.
This video has been brought to you by Alpare.